Here's the big picture. Take the S&P and the Dow out of it. Just look at the All Country World Index. The ETF for that is ACWX. That's global stocks without the United States in it. Or, if you prefer, take a look at the EFA Index, which is the rest of the world developed. The ETF for that is EFA. They're both hanging at new highs, and that is something that not a lot of people expected going into this year. There was this conversation about how the trade war would be damaging to Europe and Brexit would be damaging to Britain. What if I told you German stock market's up 25% year to date, and Japan's up 17%, and the United Kingdom's up 28%? You probably wouldn't have expected those things to be happening. And I think that backdrop is important when we think about U.S. stocks because one of the big problems that we've had in prior years is that lack of follow-through from stocks around the world and people complaining, oh, it's just 10 stocks driving everything. Well, now you got both. 3 out of the 4 most important stocks to the U.S. markets, Microsoft, Google, and Apple, all made new all-time record highs this morning, along with the rest of the world. So with that as your backdrop, you're free to think that you're smarter than everyone else on Earth. That's fine if you want to. Or you can say the breakout is for real, another new leg higher for the bull market.
Okay, so, Joe, as I said at the top, even the most notorious, quote-unquote, bears are getting more positive. None more than Mike Wilson, Morgan Stanley, the man who sat right where Steve Weiss is. Large case called a lot of this correctly, even though missed some of the upside since then. He raises his S&P 500 targets by 10% for year-end 2019. Now, he was below many others, so he's coming up to speed, and in some cases exceeding that. His bull case is 3,250. His base case is now 3,000, but let's focus on 3,250. Quote, our call on the S&P's level has been too cautious as we underestimated similar dynamics like central bank easing, sticky out-year earnings estimates, and flight to safety flows into the S&P from international investors and asset allocators. Mentions year-end performance chase, mentions a trade deal as being another catalyst. So Wilson's come around. That's the final straw to drop. We're going higher between now and the end of the year. How much do you think we have in the tank here?
So we are in the process of going higher, and the good formula for that has been this continued rotation. It seems as though at one moment value takes the baton and leads the market higher, financials and energy. I think in the last week something important happened. We went back where growth names have taken the baton once again and are leading the market higher. Even some of the bond proxies that we felt should be reduced in terms of allocation, last 5 days they're coming back once again. So we continue to have this legging process from one strategy in the market to another that is climbing the stairs higher and higher to the end of the year. 3,250 on Mike's upside. That's only 4.5% higher from here. I think.
But you do that between now and the end of the year.
That's a lot. That is a lot, and I think that's a little bit aggressive. But I do think into January you're going to see the positive momentum that we've developed here in Q4 continue. So you could skate into February and get your 4.5%. Where we go from there, I'm not necessarily sure.
So Shannon, the question is this what the so-called blow-off top starts to look and feel like, okay? You got stocks up 2% over the last 2 weeks. If you get 4% between now and the end of the year, you've got stocks rising even as the economy, pretty good. Forecasts for the fourth quarter are coming way down, though. Some are just downright ugly, okay? Now you got the bears turning bullish, and you've got even some of the bulls turning even more bullish. Sign of a worry or no?
I think if you're, as Mike Wilson pointed out in his report, if you're an asset allocator, the last thing you want to be doing is taking equities off the table right now. You want to move into the year end with as strong an equity position as you can possibly have, show that you've been there, you've already been there the whole time. I think the concern that I see is that if you look at it in terms of some of the economic data that's come out, like Friday's retail sales report, top line, pretty attractive. Underneath, the data wasn't as strong as we would have liked to have seen, and we can see that as we go through the holiday season. I think the biggest challenge that we have now is, where do you go next? Bonds remain unattractive. As Josh pointed out, if you really are expecting to see a rotation from value to growth, you should also be seeing a rotation from the U.S. to international, because the divergence is just as wide, if not wider, between those two. And so I think we could get some support. But I look at 2020, and I look at what's coming up in the first quarter, and I look at a lack of trade resolution because I don't think we're going to have a resolution with China. I look at an upcoming election. I look at concerns about where the Fed actually sits as it relates to data dependency. And it feels a lot more like January 2016 to me, where I feel a bit anxious than, feeling as bullish as some of these reports are.
Okay.